Joining us right now for more on the markets is Nancy Curtin. She is Global Chief Investment Officer at AlTi Tiedemann Global. And Nancy, thanks a lot for coming in today.
Delighted to be here. Lots to talk about, right?
There is. Why don't we start, first of all, with the consumer? Just because we just heard from Home Depot, we heard from Walmart last week. There are some concerns about whether the consumer's hanging in there or not. I mean, I think if you look through it to some extent, these companies are saying they're operating well. They are seeing some strength from the consumer, but they're not necessarily looking for a whole lot of improvement from the economy this year.
Okay, so I think you need to look at what really is behind the GDP in the United States, which is 88% of consumers have homes, stock market, cash in accounts. That's what drives consumption. The first estimate of GDP, consumption was 4.2%. So I think you're talking about lower end consumers, and there are some difficulties there clearly. But let's step back. What really drives consumption in the United States is the 88% of consumers that I would call are medium to high end. And we're not worried about that. There's a huge amount of wealth effect, enormous amount of wealth sitting in home equity. Low leverage, the lowest in over 2 decades. So, no, we think consumption remains pretty solid in the United States in the drivers of consumption, which, as I said, to mid to upper end consumers.
So where do you think we stand overall? There have been questions about inflation. There have been questions about what the Fed does next. What do you think?
I think in terms of the Fed, look, we have a PCE number on Friday. It's probably going to come out all right. It's expected just on base effects to be around 2.6%. So I think it'll be all right, right? The Fed is in a wait-and-see mode. They're going to wait and see what happens to all these things happening with Trump. So don't expect interest rate cuts to be very helpful here, at least not in the first half. Maybe the second half, maybe 1, maybe 2 cuts. But look, we're stepping back and we're saying, where's the growth going to come from? We talked about consumption. We think investment spending will surprise on the upside, the eye of GDP. I mean, you got a lot going on there. Inventory to sales ratios are low. Companies need to replenish production. And then you've got some really, really powerful demands like digital infrastructure, power, tax cuts, deregulation, put all that together. So look, earnings drive markets. And we think earnings, we're already in the fourth quarter earnings season. We think earnings for 2025 will be pretty good. So got to step back from this, the noise from the signal.
The other big earnings report we get this week is NVIDIA. That's coming after the bell tomorrow. You are underweight the Mag 7. Why is that?
Look, the Mag 7 have turned into cash machines, profit machines, into very, very heavy CapEx. And we don't know if all this CapEx expenditure, when, how it's going to result in return. You heard Satya Nadella earlier last week talk about the fact, hey, compute power is going down. What we know is prices are going down. Maybe I'll lease some data centers. Maybe I won't build so many. So our view is you got to focus on the spending beneficiaries, not on the spenders. So let's talk about power, energy infrastructure, or how about the other 493 shares that will take advantage of Gen AI as it begins to go into the enterprise, and that's not priced in. So yes, we're underweight the Mag 7, and also that removes a bit of risk from the portfolio, right? That's what drove markets over the last 2 years. So we kind of like that from the position.
So you're not underweight stocks. You're just underweight those. You like the other 493.
Correct. And we like mid-cap as well. We think it benefits from America First, attractive valuation, et cetera. And I'll share with you a bit of a bifurcation. Mag 7 traded 36 times earnings. Rest of the market at 16. If we get about 15 plus earnings growth, that doesn't sound too bad, right? So again, markets move higher with earnings growth typically.
What leads to that transition? It feels like we've been waiting for Godot, waiting for the leadership to kind of shift over.
I think it started to this year, right? We've had a bit of a wobble last week. Markets have been a bit softer in tone. But if you look at overall the characteristics of the market this year, it's not been led by technology and the Mag 7. It's been led by the other sectors, industrials, financials, et cetera. So, materials. And look at what's happening in the rest of the world. They've also been pretty strong as well. We see a narrative shift happening there. So we think it's beginning to happen with volatility.
I will say Frank Holland was pointing out some drops that we've seen in stocks in the last hour. And he was just saying Walmart down 10%, Goldman Sachs down by 7%, Palantir now down 25% over the last week. When you see moves like that, and those aren't Mag 7, Palantir is a different story. It's been up pretty phenomenally. But when you see a Walmart or a Goldman Sachs have a drop like that, it does make you think, well, what's going on around the edges?
One of our messages to clients is sort of fasten your seatbelt, right? This is going to be a year of a lot of volatility. But as I said, you've got to separate the signal from the noise. We are longer-term investors. We're not trying to trade things short-term. What's the big themes that we think about? Broadening in market participation, some participation from the other international markets, which have been largely ignored. But also, we don't just buy stocks for clients. We have diversified portfolios. We've got things like private credit, infrastructure, gold, done pretty well. There's other ways that you can sort of protect the portfolio to provide more resilience, really, for a wealth investor.